today. So where will rates end up? And what does it all mean? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin.
Great to have you on. And boy, you've been shaking the trees this week with your prognostications about higher interest rates, much higher interest rates for longer. That shook a few people.
Yeah, look, I hope it has. I don't want to scare people, but I want people to be prepared, that's all. And what Martin's referring to is that we sort of dug into the history of interest rates, and the cash rate's gone back for 33 years, and there's readily available history if you're interested, but you don't have to because I've done all of that. And the long-term average over 33 years for the cash rate is 4.6%. Now on Tuesday we saw it go to 3.35%. That's another 5 increases. I hate to say it, and you know it's sort of the averages can be a real confusing thing because frankly that period of reporting at 33 years started with an interest rate of 17.5%, and that returned to 7.5% over the ensuing 2 years. So what we then did is that we cut out that sort of surplus 10% and said, what if it had been 7.5% for those first 2 years? And then we said, okay, now then the average now has fallen by 0.5%, but it's still 4.1. So it's still a lot higher than we are right now. And we cut out the 17.5 because we said, well, look, that's not normal. It's sort of an aberration. It's something you wouldn't normally expect. Equally, though, we could have said, cut out the last 2 years where the rate has been virtually zero. And that would have bumped it right back up again, because that also is an aberration, frankly. We're not going to get that again soon. So we're not saying 4.6% right away. I think we're probably still set for another at least 2 increases. It could even be 3 before the Reserve Bank stops in this current lightning trend. But don't be surprised if we avoid recession. Don't be surprised if we get a few more increases down the track.
Yes, and it's interesting because the Federal Reserve has been talking about higher rates, and the markets in the US have suddenly turned, and a lot of people are now taking bets on considerably higher rates, 5 point something plus, whereas even a week ago, people were actually betting on Fed falls. So there is something, I think, a bit of a change in the weather. But you make a really important point here that long-term averages are higher than where we currently are. I think the other thing to think about, Steve, is just how quickly rates have gone up from 0.1 to 3.35, right? Now, in terms of percentage multiples, that is way quicker than when they went up to 17%, a couple of decades ago. So this is a pretty unheard of state of affairs. I had a few people, frankly troll me and say, no, rates were actually much more expensive and rose quicker then. No. For percentage terms relative to where they started, this is unheard of.
Yeah, it is. And the journey to 17.5% wasn't a nice up every month. It was a journey that went up and then it plateaued a bit, then it came down, then it went up again. So it was a different sort of journey. This was consecutive months for every single month. So it's now been, is it 10 now, 9? Anyway, you skipped January, of course. But it's been consecutive. It's been absolutely relentless. So it is very different from anything we've seen before.
Yeah, and the circumstances, of course, were that rates were taken probably too low in response to the COVID thing, and then inflation took off, and they've been trying to catch it. And of course, the question is whether, in fact, they will be able to catch it, and at what point, will the interest rate moves actually really have the effect they want?
Yeah, it's interesting. Low interest rates seem like a godsend, a gift. The universe has bestowed on me the ability to do all sorts of things that I thought that I'd never be able to do, and I can virtually borrow without cost. And it's been an extraordinary period. And this is the problem with low interest rates: that decisions are made that are just flawed. And when you've got the low interest rates, you can get away with all sorts of mistakes because you're not paying away much. But then when it changes, suddenly people find out, well, actually there is a cost to this. There's a cost to borrow, and there's a cost to my lifestyle moving forward, and this is now a huge adjustment. And we've got a whole bunch of borrowers who weren't even in the market when rates were 3% and 4%, who've now entered the market when rates are down at the cash rate I'm talking about now. They've entered the market when cash rate has been below 0.1% or lower. So, the decision making has been kind of like nothing will ever change. This will always be good, and it's not right now.
No, and it's worth reflecting that through that very low interest rate cycle, we had politicians, frankly, spruiking property as a great time to get in, here from first homeowner grants, et cetera, We had the Reserve Bank, obviously, yield curve controlling as well, trying to keep rates ultra low and giving the banks term funding facility money at nothing. All of those things are part of the reason why we got the problem we've got now.
Yeah, they are. And when you think about first home buyers, it's a great case in point. We also did a piece of analysis on affordability. Now, for the last 10 years, the affordability problem that first home buyers have had has been about putting the deposit together, because it's been a big deposit, ever growing. It's changed now, totally turned around. The affordability problem now is about repaying a loan. And if you're on an average income, the amount that you can afford to repay, the size of the loan you can afford to repay, has fallen by $135,000. And now, basically, you just can't buy, certainly even the median home unit, you can't buy in Sydney or Melbourne for the sort of amount you can borrow. And that's carved a lot more off the borrowing power of first home buyers than interest rates have. There's now a big but. Now, so you'd think, well, I'm a first home buyer. I didn't enter the market. I thought there'd be a buying opportunity when prices fell. Well, you know what? Maybe you're still better off than someone who did enter the market on a very small deposit with a big fat loan, paying top dollar in the market, and now having absorbed all of the 3% buffer that APRA requires, and suddenly you can't afford the loan repayments because all of the calculations today, if you went to the bank, would say you can't afford it. And you also have seen a 12% fall in your property price, with maybe more to come, who knows. So, maybe even though first home buyers who didn't buy are thinking, well, we've missed the boat, maybe it was a good boat to miss in a lot of cases.
Yes, actually, I've spoken to a few people who were looking to get in and then didn't, partly actually listening to us and saying, hang on a moment, I think, what happens if rates rise? And they're now quite grateful that they didn't get in. I've also heard from a number of people who did squeeze in, some of these 5% schemes and things, when interest rates were sitting around 2% on a variable. Then now they're actually paying a lot more. But this is other cohort that's got the fixed rates at 2%, and know that in the months ahead, it's going to jump very high. And some of them are saying, I'm not sure how we're going to cope with this. So you can see that there are signs of distress, in the market, and that's going to obviously have significant pressures on home prices, but also more broadly on household finances. Yeah,
and that the moment for that fixed rate conversion to variable is coming right up very soon. The peak in fixed rates was about 18 months ago or something, and you could fix for 2 or 3 years for 2%. Now 2% it's just unheard of, that sort of rate. And the amount that some of the big banks were putting into fixed was between 40 and 60% for a period there. Now anything that was written for 2-year fixed is now either has come up in the last couple of months or is coming up in the next couple of months. And it will start over, and then 3 years will come in a year's time. But we'll see this constant roll of loans coming due to come off fixed. You'll be going from a 2% in a lot of cases to maybe a 7% rate or a 6% rate. And your your repayments are more or less going to double, and that's double in one hit. So it's going to be an awful shock for people in that category. Refinance is already sky high. It's going to just go through the roof when that happens. But a lot of people might find that, the buffer over and above what I was borrowing is, that's well and truly gone. It's happened overnight. I haven't had time to think about it. But you do have time to think about it, because if you've got another year to run, you've got a year to think about it. And the way to think about it straight away is, you're not going to refinance straight away, but the way to think about it straight away is, look, I'm going to be up for double the repayment. I'll try to start it now. I'll try to start right now and see if I can. But at least if I can't, if I can increase it and cover 2/3 of that or half of that increase, at least I'll be able to put that away into an offset account or redraw so that I can access it to help me with the repayments when I do eventually convert. So you can do something about it now. You've got to think about it right now. Pat yourself on the back and say, good job, I made a good decision then. Make a good decision now and get ahead.
Absolutely. Plan ahead. Don't just put your head in the sand and say, well, the RBA will drop rates by later in the year. It's not going to happen, unfortunately. The RBA is saying that inflation will still be above target through 2024. That means that rates will stay high.
And Martin, the Reserve Bank Governor's comment, the very last paragraph was amazing. It said absolutely categorically, this is about inflation. If inflation doesn't come down, interest rates keep going up. And then he made the prediction that there would be further rate cuts this year. And there was a little
rate rises.
Rate rises. Yeah, sorry, rises. There was a little S at the bottom of that, at the end of that word, rate rises.
Yep.
That's two more. A week and a half ago, 2 weeks ago, I was saying I think there'll be 2 increases this year, the first half of this year, and that will be a pause, and then we'll see what happens. And I expect further rates increases down the track. But I said 2. I'm still saying 2 before they pause, except that we've just had 1, so it's 2 more. But it could be 3 more before we pause.
Yeah, absolutely. Although definitely more rate rises, just a question of timing this year. But I guess the other interesting observation, you mentioned refinancing. Eubank came out and said, okay, you can now refinance up to 35 years rather than 30 previously, which I think is a new phenomenon in Australia. You could get a 35-year loan starting from scratch, but to refinance for 35 years, I'm quite concerned about that, because I think people might actually go for that. Well, it'll help me with my repayments in the short term and it might get them through, but they're paying a lot more because of it. Yeah,
apparently they've had that loan for a little bit of time, which surprises us because we thought it was a new one. But anyway, that's as it is. But the concept is interesting. I mean, it is a way. Refinance. You could always go in and refinance and say you take a refinance at the normal 30-year term. And if you're 10 years into your home loan, well, you've effectively made your loan a 40-year arrangement. So you could always do that. Now it's an extra 35 years. So let's say you have been a customer of whatever lender, and you decide you're having trouble with the repayments, you want to refinance, you get a reasonable rate from Eubank. It's not bad. And on top of that, you can go to 35 years. So you can start the clock again at 35 years. You've had your loan for 5 years. Now it is a 40-year proposition. Now, the good thing is, and the reason this might work for some people is that your repayment is $400 less per month, based on some assumptions and the loan size of $500,000, all that sort of thing. So you've saved that, they've taken that pressure off the household budget. The problem is that your loan now is over 35 years and effectively over 40 years. The 5 you've already had, the 35 you're refinancing by. So over the life of the new loan, you're paying $170,000 roughly. It's $170,000 roughly on total interest payments over the term of the loan. Starting from today compared to just paying off your existing loan. Now that's a lot of money to be paying. It's a huge amount of money. And instead of you borrow at 30, you take a 30-year loan, it's paid off when you're 60. Instead of that now, it's paid off when you're 70. And that's, really 70. Should you be repaying your loan at 70 still? Not. So that's the problem people have. Now, if in desperation it's the only way that you can save your house, well, maybe you do it. But it's going to cost you a lot long term. And if you do it, review it in 2 or 3 years' time. And then if you can't fix it, then do it another 2 or 3 years' time. But review it to say, all right, my objective is to get this back onto the original 30-year trajectory. How much do I have to increase my repayments by now to do that? Now, it'll be a fair bit more, but, that's what you've got to do if you go into this arrangement, or you'll end up paying it out of your superannuation when you retire, and you'll be, behind the 8 ball to be standard of living in retirement.
Absolutely. And the point, of course, is that sometimes people don't think that far ahead. And so they just think about the next few months and the next few months. And then suddenly you realize that you've spent all of this time paying off. And of course, we know from all the surveys, the ABS surveys and my surveys, that the greater proportion of people who move into retirement than previously go into retirement with a significant mortgage still around their neck. And that's a problem.
Yeah, it is. It is. All of those, living in retirement, how much do you need to retire on? You have all sorts of different numbers bandied around, and people say, $1 million. It might be more or less. You draw down that money over time. And the whole premise of that is you do draw down the money over the retirement life, and you get to the point where your needs do diminish, and you kind of, you can eke the money out. But if you are paying off $200,000 of your mortgage out of your retirement money, well, gee, your superannuation better have a fair bit more in it to cover that.
Absolutely. Or, as you say, you raid the superannuation, and then ultimately you fall back on state pension, which is not the idea of what superannuation was about in the first place.
I think we've lost sight of that in Australia in the debate. But
it's a very interesting question. What is superannuation for? It's not meant to be to pay off your home loan, right?
No.
I guess the other question then is, the RBA moved, the majors have pretty much everybody else has moved on the rates on the variable rate mortgages, so they passed on the 0.25. But the story on the deposit side is quite interesting and complex. In fact, CBA just put out a release a little while ago and said, we'll put some rates up by quite a lot more than 0.25. But you've got to read the small print, haven't you?
Yeah, look, I actually haven't read the CBA, so I didn't realise they came out this morning. Yesterday, only I think NAB and ANZ had come out. NAB said nothing about deposits except that we put some up during the month, and over the period of time we put some up by a fair bit. ANZ came out and said that they're increasing one of their accounts. Now, it is the newest of their accounts, and it's only got $2 billion worth of deposits in it as of December, and they haven't made an announcement about the major savings accounts they've got. So their major online savings account, they're all online now, but their major online savings account and their bonus account, they made no announcement about that, just this one that's only got $2 billion in it. So there has been no increase really for most of their savers out of this. NAB said nothing. Whether they come out in the next couple of weeks and do something, well, we'll see. And it sounds like the story from what you're saying sounds similar with Commonwealth, that some savers have benefited and some haven't. This has been the trend ever since the Reserve Bank started moving in May last year, and some get something one month and they miss out the next month, and the other guy gets, so they leapfrog each other, and which means that they effectively get half of the increase, or they get 0.3% instead of 0.5% that the Reserve Bank moved by, or the bonus, the increases applied to the promotional introductory promotional rate, which is for 2, 3, or 4 or 5 months, but not available to existing savers. So it's been the way that they've managed the cost of the deposits that they're lending out, and the savers are missing out unless they have shopped hard and found the good rates in the market, because you can get 4.5%ers on the market, and you've got to look around, because your own bank might not be taking care of you.
No, and the CBA is interesting because they've got a bonus bit, and then they've got the standard rate, and they're basically tacking some extra on the bonus. So the point there is you might get a little bit more for a short period of time, but if you don't then check it in a few months' time, you'll be back down to a lower rate again. So it really makes the point. You have to shop around, you have to know where your rates are, and you have to keep a finger on the pulse here, because this market is moving so fast, and everybody's trying to sort of not do too much too quick, because they want to secure additional margins, because they're all giving it away on the lending side. They'll offer you $5,000 or $3,000 to refinance, and they're trying to actually beat each other on the refinance rates. Well, who's paying? Existing borrowers and depositors.
Yeah, that's right. The existing borrowers are interesting, because what we've said is, look, the average interest rate for home loan in April last year, so prior to the Reserve Bank moving, was 2.98. After 3%, where we had the pause after December, 3% made it for borrowers, existing borrowers, did get the full 0.3% pushed on. So 5.98. But the average loan rate for new borrowings is 5.67. So even over that period of about 9 months, there's been a gap open of another 0.3% between existing borrowers and new borrowers in just that short period of time. So you can imagine what it's like if you've had a loan for 10 years and have done nothing about the price, how much you're behind.
Yeah, and Steve, one of the other questions I think we've got to ask here is the way that these saving accounts are structured, because my feedback from my audience is they really don't understand how this all works. And look, it's a bit of a mystique, and I think the mystique has frankly been created by the banks deliberately.
Yeah, it has. It's the way they manage their margins and stay competitive in the headline rate. And the headline rate is the big one that's advertised. And then you look at the fine print and realise, well, you don't have that for long. Yeah. So there are 3 types of accounts. One is just a base rate account. There's just the one interest rate, straightforward. You can do whatever you want with the account. The interest rates on that one have gone up maybe about half to 2/3 of what the Reserve Bank increases have been. But it's straightforward and simple to understand. Then you've got the bonus accounts. And bonus accounts have a tiny base rate. It's only about average 0.25 or something. It's minute. And but on top of that, you get a bonus, and the bonus is probably at the moment around 2.75 on average, about 3 point something percent. So, if you achieve the bonus, and that's on average, if you achieve the bonus, you get a reasonable return on your money. If you don't achieve the bonus, this is every single month, you will miss out on the bonus element and get just 0.25. So you have to make sure you get the bonus. Now, the bonus conditions are the issue then. You have to choose an account with a good interest rate, but one that has bonus conditions that you will meet every single month. So if you need to draw on the money, don't take out an account that says no withdrawals, because the minute you withdraw $1, you miss out on the bonus interest for that month. Now, some of them are pretty good bonus conditions, and it's sort of like you have to have a linked transaction account and do 5 FPOS transactions or something, and you might have to have either a salary credit or put $2,000 in a month or something like that. So they're reasonable, because a wage and salary earner can generally achieve that without even trying. It's just in the normal course of business. Some of them say no withdrawals, or you do grow the balance by some thousands of dollars. Those ones are tricky for a lot of people, and you will miss out if you're not careful on some of the bonus interest. So you want to avoid those. If you're a retiree, you might have a problem because you don't have a salary credit. You might not have as many transactions. So it might be harder to meet some of those bonus account conditions. So be careful. You can still shuffle your finances, but you get away with it. Now, the third sort of account is the promotional account. Now, that's like the base one, just the same standard savings account, except that most of the interest is in an introductory bonus, or half of the interest is in the introductory bonus. And a lot more than their share of the increases that have been paid over the last 10 months have been to the promotional. And the promotional rate is available for 2, 3, 4, 5 months. And after that, you revert to the base rate, which is low, and existing customers do not get the benefit of a promotional rate. They're just new customers to that product with the bank. So you've got to move your money at the end of the promotional period. So that one's a real problem if you're not prepared to keep shifting your money around every few months, which is a pain, but you can do it. So, you can shuffle these things by having multiple accounts, and you can figure out how to, trick the bonus account into thinking there's been a big deposit when in fact you've just moved some money from somewhere else. So there are ways of doing it, but they're all painful, and you must kind of read the fine print and think, is this going to work for me or is it not? Because that's the only way to get a decent rate at the moment. There are a few accounts that have really nice bonus rates, and there are accounts that have really, really good base rates, and there are accounts that make it easy with the bonus rate. You can get 4.5% and 4.7%, and so look for it and take advantage of the government guarantee up to $250,000, but shop for a good rate when you've got savings.
Absolutely. Well, I'm still sitting on my 4.95% from last November, and that's a term deposit rate, and I still think I've done pretty well. We'll see how it plays out. Yeah,
well, you have. Perversely, they have fallen. Term deposit rates. You won't get a 4.9 anymore. You'll get a 4.75 or something. And it's because the longer term outlook, people say rate increases will stop. So term deposits stop sooner. So it sounds perverse, but they have actually fallen a bit over the longer terms.
But the key point we're making here is you can't just set and forget all of this stuff, right? Whether you've got a loan or whether you've got savings, because the way that the banks manage their margins is to effectively assume that you're going to be lazy, assume that you might be attracted by the nice shiny headline rate, but then it degrades over time. And unless you are actually proactive and do something about it, they're going to milk you. And at the moment, I have to say that there are many people being milked very severely in this higher interest rate environment, which I think is, by the way, unfair on those customers. Because the fact is, they can do so much better if they did, but actually go and check and ask what rates and all those things. And yet, a lot of people, it's too hard. I can't be bothered. It amazes me, particularly now, because actually you're just leaving money on the table for the banks to bolster their profits.
Yeah, and it's in savings and loans. You'd think loans people would be more conscious of it, but Canstar's Consumer Pulse survey, which was done in December, showed that 50% of people, half of people, said they had not renegotiated their interest rate with their bank over the last 12 months, and they had no intention of doing it in 2023. Half of people, the saving, you can get a loan that is 1.5% roughly. It's a bit more than that. It's about 1.6 lower than, well, whether you qualify for it, I don't know, but it's with a small bank. But it's 1.6 something percent lower than the average across the whole market. That's 6 Reserve Bank 0.25% increases. So you've effectively absorbed half of 2022's Reserve Bank increases. Wow, it's $500 a month. Why are half of people saying, I have no intention to refinance in 2023? What?
Well, I always say to people, think about the alternatives. How are you going to save $500 if you're not actually able to slice your rate, right? Well, what are you not going to spend your money on? How many subscription services are you going to cut? How many eating out so you're not going to eat out at, right? To try and do it.
Yeah.
I mean, this is such a pain-free option.
Yeah.
But a lot of people say, it's too hard. No, it's not. It's not hard. There's Canstar's site is there. You can make the comparisons, and actually you can quite often move quite quickly. online. The processes are relatively straightforward. And of course, the banks have an obligation to help you move. So there's really no excuse other than laziness.
Yeah, there's no excuse. And it's the best defense right now for any borrower is to get into the lowest rate they can right away. Keep your repayments higher than what the bank is asking for, if you can, but get into a low rate right now. Build your buffer. Make sure that you're prepared for further rate increases, but you've absorbed them by refinancing into a lower account. And, you've got to look at the budget in all of your spending. Yep. But we did a piece of work on this also in the last couple of weeks. And the $12,000 increase on a $500,000 loan over the last, this period of interest rates going up, that's how much it is, $12,000 per annum increase. That covers your home insurance, health insurance, car insurance, NBN, broadband, electricity and gas bills, the average household of all of those bills. It covers all of them. Now, all right, you can't. You're paying $12,000 more. You're not making $12,000 to pay those bills. But it's the point of it is that this is such a big household budget line. Now, it's the biggest by a country mile. And you've got to attack it first and get it down as low as you can, and then say, all right, what else do I have to do to make these repayments? But do the home loan first and do it right now and build up a buffer by getting ahead.
Yeah, and it's worth, I think, underscoring that the easy answer of, well, I'll just put a bit more on credit cards, or I'll go buy now, pay later, or, a personal loan, that is a much more expensive and risky route. And quite often what I see in my surveys is that people have big mortgages, they then ramp up their credit card debt as well, and they end up getting into this debt spiral, which is really hard to get out of. And by the way, some credit card rates have also been put up recently as well.
Yeah, and credit card rates are so much more than your home loan rate that right away you're behind the eight ball. Plus you're introducing another repayment. And it's obviously not the way to go. Now, if there was absolutely no choice, you might do it for a couple of months, 2 or 3 months, and then find a better long-term answer. But, you can't do it indefinitely in the hope that interest rates fall and your repayment will return to a lower level, because, we are a long way away from an interest rate fall. The only way we'll get an interest rate fall in the next couple of years is that we go into recession. And I don't think we'll wish that on anybody. You go into recession and you lose your job on top of it, and now you can't breathe. It's all over and over. So, don't hope for that. So there won't be an interest rate decrease, and so you've got to plan for it and make sure that you have a long-term plan that says, yes, here's money in or less money out. That's the only choices. So you either earn more money or you pay away less money. So you might be savage on your budget for the next couple of years, but that's the way it is. You just have to kind of work out a way to survive the tough time before you hopefully will get into a more comfortable level of debt to the income you're earning.
And that's why when I measure mortgage stress, I look at it on cash flow terms and look at money in and money out, because it's the two sides of the same equation. You can't just look at the mortgage element in isolation. You have to actually look at the whole household cash flow in, cash flow out. Real wages are still going backwards. Inflation is still very high. That means that many households are really getting caught. And of course, these other pressures from higher rates for mortgages particularly are also pressurizing as well. So not surprisingly, mortgage stress is harder than it's ever been. And the point to underscore again, and you've said it, but I want to say it again, don't assume that rates are going to drop in the next few months. The real estate guys are still spruiking that's what's going to happen. It's not going to happen. Yeah. That rates are going to stay high, and they could go higher. And that means that essentially these cash flow pressures are going to continue to build. So households need to actually first understand what their cash flows look like. So, recording money in and money out so you know where it's going. But secondly, then knocking off the big numbers first, as you say, mortgage first, look at savings if you've got savings too. Because you can make some changes to the way that you do things, which are less painful than the most obvious ones, which is I'll stop spending on other things. And by the way, it's really tough to stop spending. If your mortgage rates continue to rise, you still might not be able to square the circle.
Yeah, that's right. Yeah. I mean, it's a moving target. Is the point? I guess we have. You sit down to your budget now based on the interest rate increases that have gone through. Now, some have already hit your loan, but plenty haven't. So you've got to already look forward to the ones that haven't come through. So you've got to do that, but then more come, and that number keeps going up. Now, that number, you've got to actually meet that number. That's the way it is. That's a number that is non-negotiable. Not non-negotiable, but there are hardship provisions, but they don't last for years. So you've got to meet that repayment. So you're right. It's a moving target, and you might have to adjust it down a few times. So it does mean cutting spending. There's no question of it.
Mm. Yeah, well, very important conversation, Steve, and thanks for your insights. And I think specifically on this dark world of the way that term deposits and ordinary deposits work, because I think most people are completely confused by that. I also find the media, by the way, don't tell the story very well on that either. So it's important that we tell that part of the story. But the message, as always, I'm afraid it's the same message. If you don't know what rates that you're on at the moment, find out. Check to see whether you can do better, because a lot of people will be able to. And you've got to expect that things are going to continue to deteriorate in terms of interest rates going higher, therefore mortgage rates going higher. So plan ahead, get ahead. And as you say, if you can make more payments quicker to get the cost down because you're reducing the balance on the mortgage, that's actually a very smart move at the moment. It is.
The outlook is will be stressed for a while. But, you and I have been around long enough, Martin, to know that, these things that pressure does last for quite a while. Yeah. But then, property prices start rising again, incomes start going up, and the repayment that looked to stretch 2 years ago now, in 3 or 4 or 5 years' time, will look a lot more comfortable. So people shouldn't lose hope. They kind of should say, well, I'm going to make these savings elsewhere. I'm going to trim my lifestyle here, but good times will eventually return, and that's the way it's always been. So people shouldn't lose hope on this altogether. No, I think that's a very good note on which to end, Steve, because, there is always light at the end of the tunnel. What you have to do is navigate the darkness on the way through and make sure that you're making as sensible decisions as you can on the way through, bearing in mind that it will begin to get easier, but it's probably going to be a year or two before we really see that light coming across. So the decisions you take over the next few weeks and months will be critical to making sure that you get out into the light sooner and into the bright light quicker. That's right. Yeah, because you're not powerless here. Yep. The right decisions will mean that you do come through it faster. And, the tunnels kind of starts at the same length for everyone, but the decisions you make good decisions, the tunnel gets shorter for you than it does for somebody who makes bad decisions. So be on the right side of this and prepare for it and think long term in your decision making, as well as surviving short term. And you do want to make sure you don't lose your house. So you've got to start with that premise, because if you come out of this in 5 years' time without a house, you're sort of like, oh, gee, the state of the clock all over again. So you do what you got to do to save your house. This is really the point through this tough short term, and it will get better. And survive the short term for a good long term. Absolutely. Steve, thanks very much. Really appreciate your time as always. We'll put links and things below to Canstar, great source of comparative data on the various products that are there and the rates that are there. And I guess we'll catch up in a few weeks when the RBA maybe announces another rise. Yeah, well, I think they will, Martin. So, either way, we'll catch up. See you later. Thank you very much. Thanks, Martin. Cheers. Bye-bye.